Slide 1, Process Costing, Mastering Mass Production Accounting. Welcome to our deep dive into process costing, the financial nervous system of mass production environments, where understanding this methodology isn't just academic. It's the difference between profitable operations and financial chaos. Process costing is to manufacturing accounting what GPS is to navigation, a precise system for tracking costs when identical products flow continuously through standardized production steps. Unlike job order costing that treats each customer order as unique, process costing handles environments where products are identical twins, flowing through the same production womb. Think oil refineries turning crude into gasoline, paper mills converting pulp to paper, or food processors transforming raw ingredients into packaged products. These operations would collapse under job order costing, but thrive with process costing. Imagine trying to track individual gallons of paint in a batch of 10,000 gallons. Madness. Process costing says, let's track the entire batch as it moves through mixing, coloring, and packaging departments. To learn accounting, you must do accounting. And nowhere is this more true than in process costing, where theory meets the continuous production lines of modern manufacturing. Slide 2, Process versus Job Order Costing, Overview. Let's establish the relationship between process and job order costing. They're siblings raised in the same accounting household but with radically different personalities. Both systems track the holy trinity of manufacturing costs, materials, labor, and overhead. Both use the same fundamental accounting architecture: raw materials, work in process, and finished goods accounts. But their applications? As different as custom tailoring versus assembly line production. Job order costing is like a bespoke suit, unique, individual, and tracked from the moment measurements are taken. Process costing is like mass-produced clothing, standardized, consistent, and monitored by production batch. Imagine Coca-Cola trying to use job order costing for each can of soda. They'd need an accounting department larger than their production facility. The key distinction isn't in the accounting mechanics, but in the production flow. Job order handles heterogeneous, custom products, while process costing manages homogeneous products flowing continuously through standardized processes. Think of process costing as the accounting equivalent of a river system, tracking the flow of costs as products move downstream through various processing departments. Remember, folks, to learn accounting, you must do accounting. The choice between these systems isn't academic. It's driven by the fundamental nature of the production process itself. Slide 3, When to use process costing. Process costing isn't just an accounting choice, it's the only logical methodology for certain manufacturing environments. 3 characteristics demand process costing. First, product homogeneity. We're talking products so identical, they're like clones. Imagine ExxonMobil trying to distinguish between individual gallons of gasoline, or Wrigley assigning unique costs to each stick of gum. Impossible and pointless. Second, continuous production. Not start-stop custom projects, but constant 24/7 manufacturing rivers where production runs for days, weeks, or months without interruption. Picture Kellogg's cereal plants where cornflakes flow continuously from raw ingredients to boxed products. Third, departmentalized production. Standardized sequential processing where every product follows the same path through specialized cost centers. Think of paper mills with pulping, pressing, drying, and cutting departments, each adding value in the same way to every sheet produced. Let me be crystal clear. Using job order costing in these environments would be like using a spoon to dig a foundation. Technically possible, but practically insane. To learn accounting, you must do accounting, and process costing is the only practical accounting system when these 3 characteristics define your manufacturing reality. Slide 4, Processing departments. Processing departments are the beating hearts of process costing, specialized production centers that transform products and accumulate costs in a standardized manner. These aren't just random work areas. They're precisely defined cost pools where materials, labor, or overhead are systematically added to every unit passing through. Think of processing departments as assembly line stations, where specific transformations occur uniformly, like mixing departments in a paint factory or cooking departments in a food processing plant. Four critical characteristics define legitimate processing departments. First, they must add materials, labor, or overhead to the product. Pure storage or movement areas don't qualify. Second, they perform identical activities on every unit. The same processes repeated endlessly like a manufacturing version of Groundhog Day. Third, their output must be homogeneous. Every unit leaving the department should be at the same stage of completion. Fourth, they typically flow sequentially from department to department, like a relay race passing the baton. Imagine Frito-Lay's potato chip production. Washing department, slicing department, frying department, flavoring department, packaging department, each with its own cost accumulation. To learn accounting, you must do accounting. And in process costing, departments aren't just organizational units. They're the fundamental structure for tracking cost accumulation through the production cycle. Slide 5, flow of costs, big picture. The flow of costs in process costing creates a financial river system that mirrors the physical movement of products through manufacturing. Think of process costing like a GPS tracking system, following materials as they transform into finished products, accumulating cost data at every step. Raw materials flow into the first department, like Hershey adding milk, cocoa, and sugar to their chocolate mixing department. Direct labor costs join the stream as workers operate the machinery and monitor production in each department, not tracked by individual employee tasks, but by departmental labor pools. Manufacturing overhead flows in according to predetermined application rates, utilities, depreciation, indirect materials, all joining the cost river. As products complete processing in one department, their accumulated costs transfer downstream to the next department. Imagine an aluminum can manufacturer where sheet metal enters the cutting department, moves to the forming department, then the coating department, and finally the inspection department, with costs accumulating at each stage. Eventually, the river of costs reaches its destination as completed units move into finished goods inventory. Remember, folks, to learn accounting, you must do accounting. And understanding this broad cost flow pattern is essential before diving into the detailed mechanics of process costing implementation. Slide 6, flow of raw materials T accounts. Materials flow in process costing creates the first tributary in our cost river system. Unlike job order costing, materials aren't assigned to specific customer orders, but to production departments where they're consumed. Imagine a cereal manufacturer like General Mills. Raw grains don't get assigned to particular boxes, but to the mixing department where they begin transformation. The T account mechanics are straightforward but powerful. Raw materials inventory gets credited as materials flow out, while work in process accounts for specific departments get debited as materials flow in. Think of department-specific WIP accounts as financial buckets collecting costs. The mixing department, WIP account, the cooking department, WIP account, the packaging department, WIP account. Materials requisition forms serve as the documentation trail, not identifying jobs, but specifying departments and quantities. Picture a pasta manufacturer where flour and eggs get requisitioned to the mixing department while packaging materials go directly to the packaging department. In companies with robust ERP systems, these flows happen automatically as production records update in real time. For complex products, some departments may add materials while others just contribute labor and overhead, like a soft drink bottler adding syrup and mixing but just labor in bottling. To learn accounting, you must do accounting, and tracking materials by department rather than by job is the foundational distinction that makes process costing work in continuous production environments. Slide 7. Flow of raw materials, journal entry. The journal entries for materials in process costing create the financial storyline that matches physical flows through production departments. The basic pattern couldn't be simpler, but its implications are profound. We debit work in process for specific departments and credit raw materials inventory. Imagine a jeans manufacturer like Levi's, where the cutting department requisitions denim fabric, while the finishing department requisitions buttons and rivets. Each department's WIP account gets debited for its specific materials. Unlike job order costing, we don't have job numbers in the account description. Instead, we have department identifiers. The entry might look like Doctor, Whip Cutting Department, $50,000. Doctor, Whip Finishing Department, $15,000. TR Raw Materials, $65,000. Picture a paint manufacturer where pigments enter in the mixing department while packaging materials enter at the filling department, each with its own distinct WIP account to collect costs. The timing of these entries matches the physical flow. As materials move from storerooms to production areas, their financial values move from raw materials to departmental WIP accounts. In sophisticated manufacturing environments like Procter & Gamble, these entries generate automatically from production system data. The physical movement triggers the accounting entry. To learn accounting, you must do accounting, and these departmental material entries form the foundation of our process costing structure. Slide 8, Flow of Labor, T accounts. Labor costs and process costing flow like workers moving between departments, assigned to production centers rather than specific jobs. The T account mechanics show this specialized tracking approach. Departmental WIP accounts get debited, while wages payable gets credited. Imagine a bottling plant like Coca-Cola, where labor costs accumulate by department, mixing, filling, capping, labeling, not by individual bottles or batches. The fundamental difference from job order? We don't use job time tickets. Instead, labor hours and costs get distributed based on departmental time records, electronic time systems, or payroll allocation methods. Picture a textile mill where spinning department employees, weaving department workers, and dyeing department staff all have their hours tracked by department, not by fabric batch. This approach dramatically simplifies labor tracking in continuous production environments. Instead of thousands of job tickets, we have a handful of departmental labor pools. Some companies maintain direct labor and overhead separately, while others combine them as conversion costs, particularly when automation makes the distinction between direct labor and overhead increasingly blurry. Modern manufacturers like Toyota often use scanning systems where employees log into work centers, automatically assigning their time to the appropriate department. To learn accounting, you must do accounting. And in process costing, tracking labor by department rather than by job creates the efficiency needed to handle mass production. Slide 9, Flow of Labor, Journal Entry. The journal entries for labor in process costing create a department-focused financial record of human contributions to production. The pattern is elegantly simple. Debit work in process for each department receiving labor and credit wages or salaries payable. Imagine a frozen food manufacturer like Stouffer's, where labor costs flow to preparation, cooking, freezing, and packaging departments. Each department's WIP account captures its share of the labor cost. A typical entry might look like Doctor, Whip Mixing Department, $25,000. Dr. Whip Packaging Department, $35,000. CR. Wages payable, $60,000. Picture a newspaper production facility where labor costs accumulate in editing, printing, and distribution departments, each receiving its allocation of the total labor cost. Unlike job order costing, where we might specify job number 12,345 in the entry description, process costing entries identify only the department. Some manufacturers use detailed labor distribution reports generated from time systems to create these entries, while others use standard labor requirements based on production volumes. Advanced manufacturers like Intel often have highly automated production with minimal direct labor, but still need accurate department allocations for the workers present. The accounting system's labor journal entries should mirror the physical reality of where employees are working in the production process. To learn accounting, you must do accounting. And labor journal entries by department create the second major cost flow in our process costing river system. Slide 10, flow of overhead T accounts. Manufacturing overhead in process costing flows like electricity through production, distributed to departments based on their consumption patterns. The T account mechanics reveal this systematic allocation. Departmental WIP accounts get debited, while manufacturing overhead gets credited. Imagine a pharmaceutical company like Pfizer, where overhead costs, utilities, depreciation, indirect materials, supervision get allocated to mixing, chemical processing, and packaging departments based on their specific overhead drivers. Just like job order costing, we apply overhead using predetermined rates, but the application base is departmental activity, not individual jobs. Picture a steel mill where the smelting department has a high overhead rate based on machine hours, while the finishing department's rate is based on direct labor hours, each reflecting the true overhead consumption pattern. The manufacturing overhead account still works as a clearing account, collecting actual overhead costs as debits and allocating applied overhead as credits. Modern manufacturers like 3M often use activity-based costing within their process costing system to achieve even more precise overhead allocation, recognizing that different products may consume overhead resources differently even in the same department. Some companies maintain separate overhead rates for each department, while others use plant-wide rates, sacrificing some accuracy for simplicity. To learn accounting, you must do accounting. And the flow of overhead costs to production departments completes the trinity of manufacturing costs, materials, labor, overhead in our process costing system. Slide 11, flow of overhead, journal entry. The journal entries for overhead and process costing create a systematic distribution of indirect costs to production departments. The pattern mirrors our labor entries, debit work in process for each department and credit manufacturing overhead. Imagine an ice cream manufacturer like Ben & Jerry's, where overhead costs flow to mixing, freezing, packaging, and storage departments, each receiving its fair share based on appropriate cost drivers. A typical entry might look like Dr. Whip Mixing Department $40,000, Dr. Whip Packaging Department $30,000, Kiar Manufacturing Overhead $70,000. Picture a semiconductor fabrication plant where massive overhead costs for clean rooms, specialized equipment, and quality control systems get distributed to wafer production, etching, and testing departments. The overhead rates used for these entries are predetermined, calculated at the beginning of the period based on budgeted overhead and expected production levels. These rates might be based on machine hours, direct labor hours, or other activity metrics that best reflect how each department consumes overhead resources. Unlike job costing, where we might calculate under or over applied overhead at the job level, process costing evaluates this variance at the departmental level. Companies like Samsung with highly automated production often find that overhead represents the largest cost component in their process costing system, making accurate allocation essential. Remember, folks, to learn accounting, you must do accounting. And overhead application journal entries by department complete the cost input side of our process costing system. Slide 12. Transferring costs between departments. The transfer of costs between departments creates the downstream flow in our process costing river system. This critical step tracks how accumulated costs move with products as they complete processing in one department and enter the next. Imagine a breakfast cereal manufacturer like Kellogg's, where cornflakes move from the cooking department to the drying department to the packaging department, carrying their accumulated costs with them like financial backpacks. The journal entry is beautifully straightforward. Dr. WIP, receiving department, CR WIP, sending department. Picture a paper mill where pulp processing costs transfer to pressing, then to drying, then to cutting, each department adding its costs to the previously accumulated total. These transferred costs become known as transferred in costs in the receiving department, representing all the value added in previous processing steps. A tire manufacturer like Goodyear would see rubber mixing costs transfer to molding, then to curing, then to finishing, with each department recognizing the prior department's contributions as part of their product cost basis. The receiving department must account for both these transferred in costs and the materials, labor, and overhead it adds directly. Some ERP systems automate these transfers based on production completion reports, creating a real-time cost flow that mirrors physical movement. To learn accounting, you must do accounting. And understanding cost transfers between departments is essential to tracking the full product cost as it moves through the production sequence. Slide 13, transfer to finished goods. The transfer to finished goods represents the moment when our product cost river reaches its delta, flowing from work in process into completed inventory. This final production transfer captures the movement of fully processed units with their complete accumulated costs. Imagine a snack food company like Frito-Lay, where potato chips complete their journey through slicing, frying, seasoning, and packaging departments, carrying the sum of all departmental costs as they move to finished goods inventory. The journal entry maintains our familiar pattern: Dr. Finished goods inventory, credit, WIP, final processing department. Picture a furniture manufacturer where wooden chairs flow through cutting, assembly, finishing, and upholstery departments, their full cost transferring to finished goods when the final department completes its work. This transfer represents the cost of goods manufactured, the total production cost of items completed during the period. For a bicycle manufacturer like Trek, this would capture the complete cost to produce each model as it finishes its journey through frame fabrication, wheel assembly, and final assembly departments. The transferred amount includes everything: direct materials from multiple departments, direct labor across the production sequence, and applied overhead from throughout the process. Modern manufacturers often trigger this transfer automatically when production completion is recorded in the system, creating a seamless flow of costs that matches physical production. To learn accounting, you must do accounting. And the transfer to finished goods marks the completion of the production accounting cycle in our process costing system. Slide 14, transfer to cost of goods sold. The transfer to cost of goods sold represents the final financial destination in our cost flow journey, the moment when product costs move from balance sheet to income statement. This critical transaction captures the cost of units sold to customers, matching expenses with the revenue they generate. Imagine a beverage company like PepsiCo, where cases of soda move from finished goods inventory to cost of goods sold as they're shipped to retailers, their accumulated production costs finally becoming expenses. The journal entry maintains elegant simplicity: Dr. cost of goods sold, credit, finished goods inventory. Picture an appliance manufacturer like Whirlpool, where refrigerators transfer from finished goods to COGS when they're delivered to customers. Their full production cost from multiple departments now matching against sales revenue. This transfer completes the manufacturing accounting cycle that began with raw materials purchases. For a candy maker like Mars, this entry captures the moment when chocolate bars produced through mixing, molding, cooling, and packaging departments finally become expense items on the income statement. The amount transferred represents the specific cost of the units sold based on the company's inventory cost flow assumption, FIFO, weighted average, etc. In integrated ERP systems like SAP, these entries often generate automatically when sales orders ship, creating real-time cost matching. To learn accounting, you must do accounting, and the transfer to cost of goods sold marks the culmination of our process costing journey, where production costs finally impact profitability. Slide 15, Weighted Average Method, Intro. Process costing offers two mathematical approaches for handling partially completed units: weighted average and FIFO. These aren't just technical variations, they represent fundamentally different philosophies about cost flow. Imagine standing at a fork in the process costing river, where you must choose which channel to follow. Weighted average, as the name suggests, blends costs like a smoothie, mixing beginning inventory costs with current period costs to calculate a single, unified cost per equivalent unit. Picture a paint manufacturer where gallons partially completed last period get their costs combined with this period's production costs, creating a blended average. FIFO, by contrast, maintains cost layer integrity like geological strata, keeping beginning inventory costs separate from current period costs, and assuming the oldest units get completed first. For most manufacturers, weighted average offers a practical compromise between accuracy and computational simplicity, which is why it dominates in practice. Companies like General Mills use weighted average because it smooths cost fluctuations between periods, creating more stable product costing. The differences between methods become particularly significant when costs change dramatically between periods or when substantial quantities of work remain in process at period end. To learn accounting, you must do accounting, and understanding the weighted average methodology is essential for mastering process costing as it's applied in most manufacturing environments. Slide 16, Key Concept Number 1, Prior versus Current Period. The defining characteristic of weighted average process costing is its treatment of time periods, blending prior and current costs like colors on a painter's palette. This approach makes no distinction between units started last period versus this period, creating a single, unified cost pool. Imagine a food processor like Campbell's Soup, where partially completed batches from the previous month get their costs combined with new production costs from the current month, creating a mathematical melting pot. The formula captures this blending perfectly, beginning WIP costs plus current period costs, divided by total equivalent units equals weighted average cost per equivalent unit. Picture a textile mill where partially completed fabric rolls have their prior period costs combined with current period production, smoothing out cost fluctuations between periods. This approach dramatically simplifies calculations compared to FIFO, which must track separate cost layers. For manufacturers with relatively stable costs like Kimberly-Clark, weighted average provides a reasonable approximation of actual costs while requiring far less computational effort. The method creates a slight distortion when costs change significantly between periods, but most companies accept this as a reasonable trade-off for simplicity. Modern ERP systems can easily handle more complex FIFO calculations, but many companies still prefer weighted average for its intuitive nature and straightforward implementation. To learn accounting, you must do accounting. And understanding how weighted average blends time periods is the first key to mastering this prevalent process costing methodology. Slide 17. Key concept number 2, separate cost categories. Process costing maintains separate cost categories throughout the calculation process, like keeping ingredients separate until the final recipe combination. This separation of materials from conversion costs, direct labor plus overhead, reflects the different timing of when these costs typically enter the production stream. Imagine a furniture manufacturer like Lazy Boy, where wood enters at the beginning of production, while labor and overhead apply gradually throughout the manufacturing process. Each department tracks materials and conversion separately because they usually have different completion percentages for in-process units. Picture a cosmetics producer like L'Oreal, where raw ingredients might be 100% added in the mixing department, while the packaging department conversion work is only 60% complete. This separation creates more accurate equivalent unit calculations, particularly for ending work in process inventory. Companies often combine direct labor and overhead as conversion costs because they typically follow the same pattern of application throughout the production process. For a bottling company like Nestle Waters, materials, water, bottles, caps might be added at specific points while conversion costs, filtration, filling, capping, accrue more gradually across departments. Modern cost accounting systems automatically maintain these separate cost pools throughout the calculation process. To learn accounting, you must do accounting. And understanding separate cost category tracking is the second key to mastering weighted average process costing methodology. Slide 18. Key concept number 3, equivalent units. Equivalent units represent the mathematical magic that makes process costing work for partially completed goods, converting in-process inventory into hypothetical completed units. This concept addresses the fundamental challenge of process costing: how to assign costs when some units aren't finished yet. Imagine a pharmaceutical company like Johnson & Johnson with thousands of pills in various stages of completion. How do we calculate a meaningful cost per unit? Equivalent units provide the answer. The formula is beautifully intuitive. Equivalent units equals the number of partially completed units times the percentage of completion. Picture a cannery with 10,000 cans that are 40% processed. That's equivalent to 4,000 completed units for costing purposes. We calculate separate equivalent units for materials and conversion because they typically have different completion percentages. For an aircraft manufacturer like Boeing, partially assembled planes might have 100% of materials, but only 60% of conversion costs applied, creating different equivalent unit calculations for each category. The concept allows us to create a mathematical common denominator, as if we converted all in-process inventory into a comparable number of finished units. Companies with significant work-in-process inventory like Intel find this concept essential for accurate product costing. To learn accounting, you must do accounting. And understanding equivalent units is the third key to mastering weighted average process costing, the concept that makes the entire methodology possible. Slide 19, equivalent unit example. Let's solidify this critical concept with a concrete example that demonstrates the computational power of equivalent units. Imagine a pet food manufacturer with 500 partially processed units at period end. These units are 60% complete regarding conversion costs, but have 100% of their materials. The equivalent unit calculation transforms these partial units into comparable completed units for accurate costing. For materials, 500 units times 100% complete equals 500 equivalent units. For conversion, 500 units times 60% complete equals 300 equivalent units. Picture a brewery like Samuel Adams with tanks of beer at various stages of fermentation, each tank getting converted to equivalent units based on their completion percentage. These equivalent units then combine with fully completed units to determine total output for cost assignment. If this pet food manufacturer also completed 1,000 units during the period, their total equivalent units would be 1,500 for materials and 1,300 for conversion, 1,000 completed plus 300 equivalent. For a company like Sherwin-Williams, this approach allows accurate costing despite having thousands of gallons of paint in various stages of mixing, tinting, and packaging. The beauty of equivalent units is its ability to create a standardized measure for heterogeneous completion states. To learn accounting, you must do accounting. And this equivalent unit example demonstrates how partially completed units convert into a measurement basis that makes process costing calculations possible. Slide 20, Concept Check, Equivalent Units. Let's challenge ourselves with a practice problem that tests your grasp of equivalent units, the cornerstone concept of process costing. Imagine you're the cost accountant at a potato chip manufacturer with the following production data. Production started on 15,000 bags of chips this period. 10,000 bags were completed and transferred to the next department, while 5,000 bags remain in process at period end. These in-process bags are 100% complete for materials, but only 30% complete for conversion costs. What are the equivalent units for materials and conversion? Take a moment to calculate this yourself. For materials, 10,000 completed units plus 5,000 times 100% equals 15,000 equivalent units. For conversion, 10,000 completed units plus 5,000 times 30% equals 11,500 equivalent units. Picture yourself at Frito-Lay performing these calculations to determine accurate cost per bag, despite having thousands of chips at various production stages. This difference in equivalent units between materials and conversion reflects the reality that materials often enter production at the beginning, while conversion costs accrue throughout the process. A tomato sauce manufacturer like Prego would see similar patterns, ingredients added early, but processing continuing throughout production. This calculation forms the denominator in our cost per equivalent unit formula, making its accuracy essential for proper costing. To learn accounting, you must do accounting, and mastering equivalent unit calculations is the gateway to understanding the entire process costing methodology. Slide 21, Step 1, Compute equivalent units of production. The first step in weighted average process costing creates the equivalent unit foundation upon which all subsequent calculations build. This critical starting point combines physical flow analysis with percentage completion estimates to determine how many equivalent units we've produced. Imagine a cereal manufacturer like Post tracking production through its mixing, cooking, and packaging departments, each department calculating its own equivalent units. The formula follows a simple but powerful structure. Units completed and transferred out plus equivalent units in ending work-in-process inventory equals total equivalent units of production. Picture a coffee processor like Folgers, where some beans are fully roasted and packaged, while others remain partially processed, all converted to a standard equivalent unit measure. We calculate separate equivalent units for materials and conversion costs because they typically have different completion patterns. For a yogurt maker like Dannon, materials might be 100% complete for in-process units, while conversion, culturing, flavoring, packaging, might be only 40% complete. The physical units and percentage estimates typically come from production management based on their knowledge of the manufacturing process. Companies with advanced production tracking systems like Nestlé use real-time data to generate highly accurate equivalent unit calculations. To learn accounting, you must do accounting. and computing equivalent units of production is the essential first step in the weighted average process costing methodology, creating the activity measure that drives all subsequent cost allocations. Slide 22. Step 2. Compute cost per equivalent unit. The second step in weighted average process costing calculates the critical unit cost metric that drives all subsequent cost assignments. This step determines how much it costs to produce one equivalent unit during the period, the fundamental building block of our product costing. Imagine a candy manufacturer like Hershey calculating exactly how much it costs to produce one equivalent pound of chocolate through its melting, molding, and packaging departments. The formula embodies the weighted average approach, beginning WIP costs plus current period costs, divided by total equivalent units equals cost per equivalent unit. Picture a paper mill like International Paper calculating separate costs per equivalent ton for materials and conversion in each production department. This calculation reflects the core of weighted average methodology, blending beginning inventory costs with current period additions to create a unified average. For a tire manufacturer like Goodyear, this might mean combining partially completed tires from last month with this month's production to calculate an average cost per equivalent tire. We calculate separate costs per unit for materials and conversion costs, reflecting their different equivalent unit bases. Modern manufacturing environments with sophisticated ERP systems like SAP automatically perform these calculations as production data gets entered into the system. To learn accounting, you must do accounting, and computing cost per equivalent unit is the critical second step that creates the multiplication factor we'll use to assign costs to both completed units and ending work in process inventory. Slide 23, example, cost per equivalent unit. Let's solidify this crucial calculation with a concrete example that demonstrates how to determine cost per equivalent unit. Imagine a juice bottling company with the following data for its filling department. Beginning, inventory costs of $20,000 for materials and $15,000 for conversion. Current period costs of $80,000 for materials and $60,000 for conversion. Equivalent units of 25,000 for materials and 20,000 for conversion. Watch how we calculate the weighted average cost per equivalent unit. For materials, $20,000 plus $80,000 divided by 25,000 euros equals $4 per equivalent unit. For conversion, 15,000 plus 60,000, 20,000 EUs, $3.75 per equivalent unit. Total cost per equivalent unit equals $4 plus $3.75 equals $7.75. Picture a company like Ocean Spray performing these calculations to determine how much each equivalent bottle of juice costs to produce through its blending and bottling departments. This weighted average approach combines prior period costs with current period costs, creating a blended cost that doesn't distinguish between time periods. For a battery manufacturer like Duracell, this calculation would determine the average cost to produce each equivalent battery, despite having production split across multiple periods. These unit costs become the multiplication factors for our next step, assigning costs to completed units and ending work in process inventory. To learn accounting, you must do accounting. And this cost per equivalent unit example demonstrates the critical calculations that drive accurate cost assignment in process costing systems. Slide 24, Step 3, Assign costs to units. The third step in weighted average process costing distributes our cost pool between completed production and ending work in process inventory. This critical allocation ensures costs follow physical flows accurately, assigning appropriate values to both units transferred out and those still in process. Imagine a shoe manufacturer like Nike assigning costs to completed sneakers transferred to the warehouse and partially finished shoes still on the production line. The formula creates a clean, logical allocation. Units transferred out equals completed units times cost per equivalent unit, Ending WIP equals equivalent units in ending inventory times cost per equivalent unit. Picture a cookie manufacturer like Nabisco assigning precise costs to both completed packages of cookies and partially processed batches still in the mixing and baking departments. This allocation reflects the weighted average philosophy, applying the same average cost to all units, regardless of when they were started. For a soap manufacturer like Procter & Gamble, this means the same cost per equivalent unit applies to both soap bars completed during the period and those still going through the mixing, molding, and packaging processes. We perform separate calculations for materials and conversion costs, then combine them to determine total costs for transferred units and ending inventory. Modern ERP systems automate these calculations, instantly assigning costs based on production completion data and equivalent unit computations. To learn accounting, you must do accounting, and assigning costs to units is the critical third step that distributes our cost pool appropriately between completed production and ending work in process inventory. Slide 25, Step 4, Cost Reconciliation Report. The final step in weighted average process, costing creates a comprehensive report that verifies all costs are properly accounted for, like a mathematical proof confirming our calculations. This cost reconciliation ensures that the sum of allocated costs equals the total costs we started with, providing assurance that nothing has been lost or double counted. Imagine a glass manufacturer like Corning preparing a report that tracks every dollar from beginning inventory through current additions to ending allocations, ensuring perfect cost accountability. The structure is elegantly simple. Cost to account for, beginning WIP plus current costs, must equal costs accounted for, transferred out plus ending WIP. Picture a fertilizer producer like Scott's Miracle-Gro reconciling costs for its mixing, granulating, and packaging departments, confirming that all costs have been properly allocated to either completed production or ending inventory. This reconciliation serves as both a calculation check and a management report, validating computational accuracy while providing insight into cost flows. For an electronics manufacturer like Samsung, this report would confirm that semiconductor fabrication costs properly flow through etching, assembly, and testing departments without any unexplained variances. In modern accounting systems, this reconciliation often serves as the source document for the journal entries that update the general ledger accounts. Companies with robust cost accounting systems like Oracle automatically generate these reconciliations as part of their period-end close process. To learn accounting, you must do accounting, and the cost reconciliation report provides the essential verification that our process costing calculations are complete and accurate, the final check that closes the loop on the entire methodology. Slide 26, Operation Costing. Operation costing represents a brilliant hybrid approach that combines the best features of job order and process costing for specific manufacturing environments. This specialized methodology addresses the unique challenge of batch production with standardized conversion processes, but distinct material requirements. Imagine a clothing manufacturer like Levi's producing different styles of jeans through the same cutting, sewing, and finishing departments. Each style requires different materials but follows identical production steps. The genius of operation costing lies in its selective application. Material costs follow job order costing principles, tracked by batch or product type, while conversion costs follow process costing principles, tracked by department and applied uniformly. Picture a printing company producing different books through standardized printing and binding operations. Each title needs different paper and cover materials, but the conversion process is identical. This hybrid approach perfectly fits manufacturers producing distinct batches of similar but not identical products. For a furniture company like La-Z-Boy, different chair models might require unique fabrics and frames tracked by model, but go through the same cutting, assembly, and finishing departments tracked by process. Operation costing delivers the precision of job order costing for materials with the efficiency of process costing for conversion costs. The best of both worlds for batch manufacturers. To learn accounting, you must do accounting. And operation costing demonstrates how accounting systems can be customized to match the specific production characteristics of different manufacturing environments. Slide 27, operation costing example. Let's illuminate operation costing with a concrete example that demonstrates how this hybrid system works in practice. Imagine a shoe manufacturer producing athletic, casual, and dress shoes through the same production departments. The materials differ significantly: premium leather for dress shoes, synthetic materials for athletic shoes, and canvas for casual shoes, but all styles go through the same cutting, stitching, and finishing departments with similar conversion processes. Here's how operation costing handles this hybrid environment. Materials costs are tracked by specific batch-like job order costing, perhaps $30 per pair for dress shoes, $15 for athletic, and $10 for casual. Conversion costs are applied uniformly using process costing principles, perhaps $25 per pair for all styles based on department costs and equivalent units. Picture Nike using this approach for different shoe models, tracking specific materials by style while applying standardized conversion costs across all production. The materials requisition forms identify specific batches, job order approach, while labor and overhead apply based on department activities, process approach. This hybrid system gives manufacturers the best of both worlds: precise material costing without the complexity of tracking every conversion activity by product variant. Companies like Coach use operation costing for different handbag styles, flowing through standardized production departments, maintaining material cost accuracy while simplifying conversion cost tracking. To learn accounting, you must do accounting. And this operation costing example demonstrates how manufacturers can adapt accounting methodologies to perfectly match their unique production environments. Slide 28, common challenges and tips. Process costing implementation comes with practical challenges that even experienced accountants struggle with. Let me share battle-tested solutions from the manufacturing trenches. The most pervasive challenge: accurately estimating percentage completion for work-in-process inventory. Imagine a food processor trying to determine if partially completed batches are 40%, 50%, or 60% finished. Seemingly small differences that significantly impact cost allocations. The solution: develop standardized completion metrics based on production milestones rather than subjective estimates. Picture a cosmetics manufacturer like Revlon defining specific completion percentages for each production stage. Mixing is 30% complete, filling is 60% complete, packaging is 85% complete. Overhead application creates another common pitfall when predetermined rates don't match actual costs. For a seasonal business like Heinz, producing ketchup, underapplied overhead during low-volume months can distort product costs. The fix: develop activity-based overhead rates that adjust for volume fluctuations. Maintaining consistency between periods presents another challenge, particularly when production processes evolve. Companies like Tesla struggle with process costing as manufacturing methods constantly improve. The solution: regular recalibration of equivalent unit definitions and completion metrics to match current production realities. Data collection technology can dramatically improve accuracy, replacing manual estimates with sensor-based completion tracking. To learn accounting, you must do accounting. And addressing these common challenges transforms theoretical process costing into practical, actionable financial intelligence for manufacturing management. Slide 29, summary and key takeaways. Let's crystallize the essential insights from our deep dive into process costing. the accounting methodology that powers mass production environments worldwide. Process costing flows like a financial river system, materials, labor, and overhead entering the stream at various departments, accumulating as they flow downstream, eventually reaching finished goods and cost of goods sold. Imagine following a drop of olive oil through a Bertolli production facility, from initial processing to bottling, watching costs accumulate at each stage. The weighted average method creates a practical approach to handling partially completed units, blending beginning inventory costs with current additions to calculate uniform costs per equivalent unit. Picture a company like Kimberly-Clark applying this methodology to its continuous production of paper products, creating consistent, stable cost information, despite having work in process at every period end. Equivalent units represent the mathematical genius that makes process costing possible, converting partially completed goods into hypothetical finished units for accurate costing. Operation costing offers a brilliant hybrid for batch production environments, combining job order precision for materials with process costing efficiency for conversion costs. This selective implementation demonstrates how accounting systems can adapt to specific manufacturing realities rather than forcing businesses into standardized methodologies. Process costing isn't just an accounting technique, it's the financial nerve center of mass production, translating physical flows into accurate cost information for pricing, inventory valuation, and profitability analysis. To learn accounting, you must do accounting. And mastering process costing opens doors to understanding the financial dynamics of the world's largest manufacturing operations. Slide 30, Q&A and closing. We've explored the fascinating world of process costing, from theoretical foundations to practical implementation challenges. Now I invite your questions about any aspect of this critical manufacturing accounting methodology. Remember that consistent departmental tracking forms the backbone of effective process costing. Without disciplined cost assignment to processing departments, the entire system collapses like a house of cards. As you apply these concepts in your own work, focus particularly on equivalent unit calculations. They're the mathematical engine that drives accurate cost assignment, despite the complexities of partially completed goods. Imagine yourself implementing these techniques at companies like Procter & Gamble, Nestle, or Ford, global manufacturers that couldn't function without sophisticated process costing systems. The methodology we've examined today isn't just theoretical. It's the practical financial management system used by the world's largest continuous production operations. From oil refineries to food processors, paper mills, to pharmaceutical companies, process costing translates complex production flows into actionable financial information. As we conclude, remember that accounting systems should match manufacturing realities. Process costing for continuous production, job order for custom manufacturing, and operation costing for batch environments with standardized processes. Thank you for your engagement. To learn accounting, you must do accounting. And I hope today's session has equipped you with both the knowledge and practical insights to implement effective process costing in your own professional work.